Hello, good day. Hope you have a wonderful day today. So, our topic for today is partnership liquidation. So, these are part of our previous topic, which is partnership liquidation. There are two. We have the installment liquidation and the lump sum liquidation. But for this particular topic, we would now focus on installment liquidation. So, let's proceed. So, our learning objectives by the end of this video, uh, hopefully, all the viewers would be able to learn the definition of installment liquidation as compared to our lump sum liquidation, and then the definition of asset on realizations and liquidation. We also have the cash priority program. In other book, it's also known as our safe payments and its computations. Okay, so let's proceed. So there are two kinds of liquidation. Number one is the lump sum liquidation, which we have discussed in our previous videos. So these are no distribution are made to partners until the realization process is completed when the full amount of realization gain or loss is known. So under lump sum liquidation, we normally sold all the non-cash asset and converted first it into cash. Then we would pay our outside creditor and liabilities, and whatever remains will now be divided among the partners in accordance with their P&L ratio. As compared to our installment liquidation, which is our focus for this video, under installment liquidation, the distributions are made to some or all the partner as it becomes available, or meaning as the cash become available. So normally, since in the real situation or in the real scenario, we would be able to sold the non-cash assets or the tangible asset in a piecemeal basis because we want to have this particular asset a higher valuations. So we would usually locate more buyers so that we would be able to sell this particular, like for example, if it's land, it would take quite some time to be able to sell this particular asset. Hence, under installment liquidation, it's still the same. We convert all the non-cash asset into cash, but in piecemeal basis. So take note that when we convert, our still priority would be paying our outside creditor. Then whatever cash remain after paying the outside creditor will now be distributed to the partner, irregardless whether or not all the asset is not yet realized into cash. So meaning as the cash becomes available, we would distribute the remaining cash to the partner according to our cash priority or safe payments. Okay? So we have now statement of realization and liquidation. What's this for? So normally, statement of realization and liquidation, from the word itself, it would show the journal entries about the procedures that had been undertaken in the liquidation process. So normally, this is used as an alternative journal entries and trial balance for the liquidation transactions. Because we would usually have a T account for the asset to be realized and the asset realized, liabilities to be liquidated, and liabilities liquidated, so that we would be able to compute for the gain and losses that are to be distributed among partners. So we also have the loans to and from are collapsed into the partnership account, because if you would check in our previous video, there are a separate column for the loans such as car loans. But for this one, all the receivable and payable to the partners will now be collapsed into the partnership accounts. So meaning it would now be combined. Since under liquidation, offsetting among the partners or offsetting with regards to receivable and liabilities to partner is allowed. So the transaction is divided into different liquidation events. So for the asset, there are two. We have the asset to be realized and realized. So asset to be realized are all the non-cash assets that we wanted to sell, whereas asset realized are those assets that are already converted into cash. So we also have payment to creditor and expenses. So these are liabilities to be liquidated and liquidated. So liabilities to be liquidated are assets that are needed to be paid. Liquidated are those liabilities that we are already paid or we had already paid in full amount. So we also have liquidation expense. These are normally with regards to the taxes, to the broker, to the accountants that would process all the liquidation papers to be submitted with the bureaus, or other government agencies. So let's have the different assumptions. So assumption under installment liquidation would be the possibility of loss on all the remaining asset. So meaning when we were be able to only sell a certain amount of the asset, all the remaining unsold assets will now be considered as loss that are divided among the partners with regards to their P&L ratio. Next, we have the potential deficits partner may unable to meet their indebtedness. So meaning all the deficit partners will be considered as insolvent as we process the save payments. Okay? So meaning they will not be able to pay or to contribute additional contribution for that. So we also have the non-cash assets are not sold over time. So meaning all the non-cash assets are now unsold, or meaning these are now losses that are to be divided among the partners. Next, distribution of cash as they become available. So meaning whenever there are excess cash would now be distributed among partners. Okay? So save payment, this means is a means on how to distribute cash to the partner before all assets are being disposed. So meaning as the cash arises, or as the coffer would have certain amount of cash, it will now be distributed among partners. So the following procedure are being observed. So a loan to and from to the partner will be combined with their respective capital account, including share on profit and loss. So meaning all accounts, since we already presume that the books are already closed, all accounts will now go to under our equity account or the partnership capital. The remaining non-cash asset will not provide any additional loss. And then the partners with a debit balance or capital will be considered insolvent. So meaning they will not be able to pay additional payment. And no partner will be able to receive cash until all liabilities are being paid. So take note that the partner will only receive cash in the event all liabilities are already liquidated. Okay? So cash priority program, same as our safe payment. This refers to the pre-distribution plan of cash to the partners in the time of liquidation. Next, we also have this is a specific order or sequence of priority in which each partner will participate in the cash distribution and the amount of each partner. So normally, the cash priority program, in here, we would wanted to identify who among the partner will have the first order to receive cash. Okay, so we would have some illustration so that you will be able to identify. So let's assume that KKR Partnership Limited balance sheet June 30, 2021 have the following. We have cash 10,000, other non-cash asset 100,000. So our total asset would now be 110,000. Liabilities is 28,000. Then Capin capital is 34,000 with a P&L of 30%. Car capital 30,000 with a P&L of 50, and rich capital 20% with a P&L of 20%. So all in all, our liabilities and equity section will be equal with our total asset, which is 110. So additional information. So sales 1, we only sales certain amount of the asset with a book value of 30,000. We only sold that at 20,000. So meaning we have a loss of 10,000. Second sale was 25,000 of the assets of our 75,000 assets or 110,000 assets at only 15,000. So there is additional loss of 10,000. And then last sales, 45,000 or all the remaining asset is only sold at 12,000. So let's compute. So lump sum liquidation procedure. So we put this on the column so that it would be easier for us to identify. So balance before liquidation, we have 10,000, 100,000, 28,000 for liabilities, 34,000 for Kevin, 30 for car, and then 18 for Rich. So realization, we have realization of other asset at 30,000. So take note, we only received 20,000 for that, but we would minus 30,000. So the losses would now be absorbed among partner. 3,000 for Kevin, 5,000 for car, and 2,000 for Rich. So balance would now be 30,000 cash, 70,000 non-cash asset, and liability would still be 28,000. So now we had to pay our creditor because we said that the priority would be paying out our outside creditor. So when we pay outside creditor of 28,000, we would still have the remaining balance of 2,000. Okay? So who is now have the priority with regards to this payment. Let's compute. So you would see that the capital balance would be 31,000, 25,000, and 16,000. So take note, we said that we assume all the potential loss or all the remaining asset become now potential loss, and that is now 70,000. So 70,000 loss, 30% would give you 21,000. So Kevin balance will now be only 10,000. Car is 35,000, so it's a deficit of 10,000. And Rich, 14,000, so a deficit of, so positive 2,000. So since car has a deficit of 10,000, it would now be attributable to the remaining partner because we assume that the partner with the debit balance is insolvent. So the remaining partner will have to absorb the negative balance. So that would be 6,000 for Kevin and 4,000 for Rich. So they would now be positive 4,000 for Kevin, no for car, but negative 1,000 for Rich. So since only Kevin has the remaining balance, he will absorb the loss of 2,000. So say payment of 2,000 or the remaining cash of 2,000 will now be payable to Kevin. Okay? You would see that it is now paid to Kevin at 2,000. So now, the capital balance would be 29,000. And then, a realization of 25,000 asset. So 15,000, we have 25,000. So loss would now be divided again among partner. So that's 3,000 for Kevin, 5,000 for car, and 2,000 for Rich. So we have now a balance of 15,000 that still be distributable among partner. So same procedure for our SAFE payment number 2. So we would have the remaining capital balance, and then we would assume that the potential loss of 45,000 would be divided again among partner. So you would see, when we divide that, Kevin will have to absorb 13,500, car 22,500, and Rich negative 5,000. If you would check, Kevin would have still a balance of 12,500, car negative 25, and Rich 5,000. So the negative 25 would now be divided among Rich and Kevin, according still to their P&L ratio. So meaning Kevin would have to absorb 1,500 while Rich is to absorb 1,000. So therefore, the 15,000 will now be attributable to Kevin 11,000 and Rich 4,000. So here it is. So if you would see, the balance of 15,000 would now be paid 11,000 to Kevin and 4,000 to Rich. Okay? So we still have how many? We still have 45,000. And take note, the 45,000 is only sold at 12,000. So if it's only 12,000, then the loss would now be divided among them again. So negative 9,900 to Kevin, negative 16,000 to Car, and negative 6,600 to Rich. If you would check, the balance of 12,000 would still now be equal to their ending balance, which is 5,100, 3,500, and 3,400. So 12,000 would now be given to their remaining capital. So it's now fully liquidated. Okay? So thank you. If you like this video, please help me reach out more people by hitting the subscribe button below. God bless you, and if you have questions, please comment below. We will have more example in the future if we would have enough activities or if you have questions so that we would clarify. Okay? So hopefully you subscribe and help me out to create more videos to help new accounting students. Bye!